Hi, my name is Sabine.
My name is Sarah.
My name is Rachel.
And we've been working with Margaret Madison, a member of Oracle's corporate development team, to look at a potential acquisition for Oracle.
The company plans to acquire Sun Microsystems.
And our task has been to evaluate the benefits of the merger using multiple evaluation methods. The first point that has to be determined is if Sun Microsystems would make a good strategic fit for Oracle qualitatively. Looking at the possible areas for revenue enhancement, cost cutting, and the synergies, we determined that the acquisition would greatly benefit Oracle and they would make a very good fit. First, we will look at all the possibilities for revenue enhancement. They could combine Oracle software systems with Sun's broad knowledge in networking and hardware. Also, this would mean that Java, MySQL, and Solaris would be added to Oracle's portfolio following the acquisition. Their products aren't in competition to begin with, so they already appeal to different areas of customers. This implies that by combining their expertise in different technologies, Oracle could sell to a much broader client base, keeping their high-end clients but also effectively serving Sun's lower-end qualities well too. Additionally, some of Sun's software could be implemented to further enhance Oracle's. A large number of Oracle's commercial clients already rely on Sun's services for some specific needs. These commercial clients would purchase software systems from Sun and use them through Oracle databases. Therefore, Sun's customer base and service contracts could benefit Oracle in terms of revenue enhancement. The largest source of predicted revenue, however, is the integration of both companies' products into a new product. The idea of this intersection of technologies was to minimize the customer setup process. This seemed to be an overall simple task considering Oracle already used Sun software Java as a base for their systems and ran using Solaris operating system. Oracle's long-term integration plan was to build Exadata machines which could handle online transactions and data warehousing. The transaction processing database machine would be created by Oracle's idea to combine their software with Sun's technology, FlashWire, and then run it on Sun's hardware. They predict this machine to be 2 times faster than the previous model and also much more efficient than their leading competitor, IBM. Also, a survey Oracle conducted asking if customers would be willing to pay a small fee for software downloads came out with very positive results. Additionally, aside from revenue enhancements, there are many potential cost reductions for Sun that Oracle could implement after the acquisition. Initially, they could reduce Sun's employees by 20 to 25%. Next, they could reduce costs for selling, general, and administrative expenses by 22 to 32%. They also have the ability to do things like streamline products, eliminate products that are no longer necessary, and restructure parts of the company that are very outdated. As we have shown above, the potential benefits that result from Oracle acquiring Sun are enormous. Therefore, we have concluded that Sun is a very good strategic fit for Oracle.
As it was previously covered, qualitatively, the acquisition of Sun Microsystem would enhance the value of Oracle in terms of diversifying its function and achieving the CEO's future vision. Although this gives Oracle an optimistic outlook, it is vital that the acquisition be valued qualitatively. There are 2 main valuation tools. One that is based on absolute values, the discount cash flow analysis, while the other focuses on relative values in the same industry, the multiples analysis. To be more explicit, the discount cash flow deals with the incremental cash flows coming from an acquisition to ultimately determine the final enterprise value. In contrast, multiples analysis is based on comparing relative measures of a potential acquisition to historical data of past acquisitions in the same industry. Performing and contrasting the 2 methods allows for better and fuller insight on the merger. So these 2 methods actually bear distinct advantages and disadvantages. The discount cash flow valuation model is appealing only if one is confident about the future cash flows of the target business, as a standalone company, in addition to the incremental gains as a result of the synergy. However, these values are a result of input assumptions. These predictions on the future cash flows, the terminal value, and the discount rate can vary widely from the actual future economical state. This is where the hesitation in valuing an acquisition using the discount cash flow method can arise. To compensate for this risk, one can perform a sensitivity analysis to assess a wide range of potential future outcomes, primarily a base case, an optimistic case, and a pessimistic case. The sensitivity analysis highlights how sensitive the calculations of the net present value is to changes in one variable, like the rate of return or the future cash flows. It further provides to the manager a range of values that this acquisition may foresee. The discount cash flow valuation method is commonly used amongst many because of how precise it can be given the appropriate underlying assumptions. The assumptions are dependent on how the company will operate in the future and react to changes in the market's economy. Moreover, they make predictions on how the bidding and the target company interact and fuse to generate synergy. In this case, we use this tool to value the acquisition of Sun Microsystem by Oracle. Another difficulty lies in calculating the rate of return, equivalently the cost of capital, since it harbors the risk of taking on the target. So the terms rate of return and cost of capital can be interchanged. They simply hold different standpoints of the same situation. So the rate of return is what the investors and creditors demand in return to the capital they provide to finance the expansion of the business. The cost of the capital holds the same idea, but in the shoes of the firm. So given the capital structure of the firm, the cost of capital measures the return needed to compensate both its creditors and investors, the shareholders. However, the value isn't determined by the source of financing, but rather by the use of the funds. Hence, the risk is associated with the investment. A very important distinction to keep in mind, actually. In this study, the investment is denoted by Oracle's attempt to acquire Sun Microsystem. Under these circumstances, we use the weighted average cost of capital of the target company because it reflects the risk of absorbing it into the bidder's operations. Okay, so WACC is dependent on the capital structure of the target company. Furthermore, the proportion of each financing source, equity or debt, is distributed to the respective required return, the cost of equity and the cost of debt. The cost of debt, the simpler of the two, can be directly observed via the firm's bond rating. For example, Sun Microsystem's bonds were rated Ba1, equivalently BB+, and the interest rate on newly issued Ba1 rated bonds is 11.42%. The capital asset pricing model, CAPM, is used to compute the cost of equity, also known as the security market line, SML approach. This method adjusts for risks since it uses the firm's beta coefficient. The beta reflects the amount of systematic risk relative to the average asset in the market. This value is multiplied by the risk premium, defined as the excess risk of investing in the market over the risk-free rate. The time horizon is captured by the risk-free rate duration. Thus, a long time horizon requires choosing the rate for a 30-year US Treasury yield. Having put these ideas together, we used CAPM formula to calculate the cost of equity. Finally, the WACC of Sun Microsystem is deduced as 12.85% that we calculated. However, we are going to use 12.05% to be consistent amongst the parts. To value the firm appropriately, we must analyze its value at the present moment. Madison studied in detail the historical performance of Sun Microsystem in order to project conservative future values of how the target business would operate as a standalone company. Likewise, she estimated the values of the synergy in the future. The synergy emphasizes the added force of acquiring Sun as part of Oracle. The summation of the two comprises the incremental cash flows in the calculation of the net present value. To summarize, the value of Sun Microsystem to Oracle consists of Sun's worth on its own and the incremental gain, the synergy, due to the combination of the two. The resulting net present value that we calculated, it was $9,142,000,000. This value is positive, and therefore it seems like an interesting idea using the discount cash flow valuation method that Oracle acquires Sun.
A multiples analysis is an alternative valuation method that focuses on industry comparisons instead of absolute valuation. Under our multiples analysis, we first select companies with similar features as Sun. We then calculate multiples, ratio statistics that include financial information on the companies and relate to the underlying factors driving the company's performance for each of these peer companies. Finally, we use these multiples to conclude how Sun should be performing and compare to actual Sun data to infer if it is under, over, or well valued. The first step in conducting our multiples analysis was to choose a peer group against which Sun Microsystems would be evaluated. Using the list of hardware and software companies provided in Exhibit 9, the first step was to strip out negative financial data values as they are outliers that will add an unwanted weight to the data distribution. Another quantitative factor to be considered is market capitalization. While the variance is significant in terms of this factor, we decided it would not be worth it to eliminate companies based on this criterion. The gain in homogeneity of the peer group's market capitalization would not be worth the loss of sample size. Moving to more qualitative factors, we only used other hardware companies, not software companies. There are too many differences between these two industries to justify comparing them directly. For example, different products, different customers, different market, just to name a few. The second step was to choose which multiples to use in our analysis, given the constraint of the financial data. A price to sales multiple was used to find an equity valuation or a value of the stock price. And then we used an EV over EBIT and EV over EBITDA to put a value on the enterprise. Before we could do this, we had to establish non-negative EBIT and EBITDA values for Sun Microsystems, and we did this using discounted values from the 2014 financial statement for Sun Microsystems. For the discount factor to do this, we use the same walk that will be used in our sensitivity analysis. Our findings were that Sun Microsystems should be trading from about $13 to $25 for a single share. As Sun is currently trading at just $6.69 a share, this is well below the interval, and there is evidence that the company is perhaps undervalued. We then conducted the multiples analysis to put a value on the enterprise. And combining what we got from the EV over EBIT and EV over EBITDA, we calculated an interval of about $3,300 in millions to $7,658 multi-million when for the enterprise value. And if we evaluate Sun Microsystems on this criterion, we get a bit different result. At a true enterprise value of 6,198 in multi-millions, Sun Microsystem falls somewhere between the baseline and best case scenario. A key reason for using a multiples analysis is to gain insight into the driving factors or economic fundamentals of the industry. Looking at the equity valuation by price to sales, there are a few outliers, Apple on the high end and Dell on the low end. In the case, it states that at the dawn of the new millennium, lines between segments were becoming blurred, in reference to the lines between software and hardware industries. With this shift, there was a role for companies such as Apple to lead the way and capture both the software and hardware markets, and control the design of an integrated product from start to finish. The potential to redefine the industry in this way contributes to investors' extra normal confidence in a company's earnings potential, paying higher than ordinary prices for stock, and thus resulting in a very high price to sales multiple. In contrast, Sun Microsystems' inability up to the merger to cross into the software industry could factor into its lower than industry norm stock price. Another industry-wide factor to consider is the post-recession industry. The stock market, including tech companies, has seen a slow recovery. This movement is well captured if you look at the S&P 500 stock trajectory, including Exhibit 9. The effect of such an economic environment is to lower the potential for high multiples for all firms.
To analyze further if it makes sense for Oracle to acquire Sun, we performed a sensitivity analysis. First, we identified that there are certain synergies we had to incorporate in order to calculate accurate NPVs. Initially, there would be a beginning cost of $7.4 billion for Oracle to purchase Sun, incurred in 2010. Then there would be $1.1 billion in integration costs, which would be incurred over both 2010 and 2011. There would be also an initial operating loss of $45 million. After this, Oracle would begin to make a profit, eventually growing to an amount of $900 million per year. This profit is a result of cost-cutting, licensing income, and new products. We incorporate these numbers with the operating income and also add the depreciation for each year. So for the sensitivity analysis, it is used to determine how sensitive our NPV is to changes in one variable while holding the others fixed. If we find that our estimated NPV is especially sensitive to changes in a variable, then the forecasting risk associated with that variable is high. We compare changes in our variable to a neutral position of the base case. The sensitivity analysis is good for determining which variables deserve the most attention. Meaning, if a variable is very sensitive to changes, we should allocate further market research to this area. In our analysis, we chose to analyze the sensitivity of our WACC and also the actual projected cash flows. Specifically, we changed our 12.05 WACC by 1% point higher and lower while keeping everything else constant. Then for our second analysis, we changed our actual projected cash flows by 10% higher and 10% lower while keeping the WACC constant at 12.05. The outcome of our analysis was that we found both of them to give us a positive NPV in every situation, that being the base case, the optimistic case, and the pessimistic case, which is a very good sign. We can also see that the estimated NPV is more sensitive to projected cash flows than it is to the projected WACC values. This tells us that the projected cash flows might need the most attention because of the degree of forecasting risk is high. However, the sensitivity analysis doesn't give an exact direction on what to do about these possible errors. It just pinpoints where the possible errors could occur.
To put a value on the upper limit for how much Oracle should offer, we use the same tools used in our discounted cash flow evaluation. Excluding the offer price in the previous analysis and using the same WACC of 12.05 that we used in both our sensitivity analysis and multiples analysis, for consistency, we found the discounted cash flows to have a value of 15,265 in multi-millions. And if we wanted to compare this directly to Oracle's current offer of $950, we could calculate that this was a price of $20.66 per share. When considering this as the highest price to be paid, it should be understood that at this price, no profit should be expected from the acquisition. Therefore, while it is the highest price to be paid without incurring loss, other qualitative factors should be accounted for when making the final decision. The result of both the sensitivity analysis to quantify the potential for variance around the expectation, as well as the multiples analysis to get a sense of the industry, might be helpful here. Another thing to note is that this result is in line with the multiples analysis. This type of analysis is useful because it gives us a range of suitable equity values for Sun Microsystem based on industry comparables. Recalling the multiples analysis, we calculated that Sun should be trading from around about $13 to $25 per share, based on the performance of peer companies. Looking at this maximum offer price of $20.66 per share, it might initially be surprising, a surprising result that we should be paying so much more than the current offer price of $9.50. However, by this multiples analysis, we can see that we are still in a reasonable range and should gain some confidence that we would not be overpaying for Sun Microsystems at this price. With this concludes our analysis of Oracle's acquisition of Sun Microsystems.